Welcome back to Probability, Logic, and Beyond. In this video, we're going to talk about the fundamentals of options. Let's start with the definition of an option contract. An option contract gives you the right, but not the obligation, to purchase or sell an asset for a predetermined price at some point in the future. An option contract has a few parameters, including the strike price, expiration date, option type, option premium, and option classification. Take a second to read and understand these parameters. If they aren't making any sense to you right now, don't worry, as they make much more sense in the context of an example. Let's consider a call option on Microsoft stock. Microsoft is currently trading at $418. The strike price of the contract is $420, the expiration date is November 15th, and the option premium is $3.10 per share, and since contracts come in bundles of 100 shares, the total premium is $310. For this option, let's plot the profit and loss curve. At expiration, we're particularly interested in the profit and loss curve as a function of the stock's price. The blue line is the current price and the green line is the strike price, which is the price at which we can choose to exercise the option at expiration. Because we're buying the option, our profit and loss curve looks like this. If Microsoft ends up staying below $420, we lose our entire premium, which is $310. No matter how low Microsoft goes, we cannot lose more than this amount. Our downside risk is capped at 100% of our initial investment. If the price rises above $420, we can see that the value of the option contract begins to appreciate, but we still don't break even until the stock reaches $424. This is called the break-even point, and it's the point at which our investment becomes profitable. The higher the stock moves upwards, the greater our profit. Further, because the premium on options contracts isn't as much as actually holding the underlying asset, we can effectively hold thousands of shares for a relatively small amount, which is why some investors choose to use options to speculate on stock movement. In this example, we're buying a call option. We can also choose to sell a call option. When selling a call option, our P&L curve is flipped like this. Now, we earn a premium if the stock stays below the strike price, and have uncapped losses if the stock continues to move beyond the strike price. Investors that are bearish on the movement of the stock can choose to sell call options to make money on the premium. Now that we've talked about call options, let's move on to put options. Let's consider a Tesla put option in which Tesla is currently trading at $334.07 with a strike price of $330, an expiration date of November 15th, and an option premium of $10.15 per share, for a total of $1,015. Let's first consider the P&L curve when we buy this put option. The blue line is the current price that Tesla is trading at, and the green line is the strike price specified by the put option contract. The P&L curve looks like this. What we notice from the curve is that so long as the price of Tesla remains greater than $330, we make no money from the trade. If Tesla moves below $330 though, the value of our option contract begins to appreciate linearly until the break-even point at around $319. After this point, the investment in the option contract becomes profitable. Just as with purchasing a call option, we can only lose the total value of the option contract that we purchase. Bearish investors can purchase put options to speculate on the downward movement of the stock. Bullish investors can also purchase put options to hedge against significant downwards moves in times of uncertainty. Just as with call options, we can also sell put options. If we were to sell this put option, our P&L curve would be flipped like this. As we can see, so long as the stock stays above the strike price, we earn a premium. If the stock trades below the strike price, we'll be forced to purchase the stock at the current price and then sell it at the strike price, resulting in uncapped losses. If we decide to sell many put option contracts, this loss would be amplified and potentially devastating. In future videos, we'll walk through how to buy and sell options using interactive brokers, we'll discuss the option Greeks, and we'll detail a handful of common options trading strategies. Thanks for watching, and please subscribe to the video for more content on probability, logic, and beyond.